because most people associate sort of fundamentals of the economy with the market. But it's never been true, and it never will be true. Markets and equities in particular have difficulty really performing well when you have a tightening of monetary cycle, tightening of fiscal cycle. And what we had in China over the last 6 months is a very significant tightening. And so it's been clear for at least a month now, if not two, that China in the second half of the year will start easing its monetary policy, will start easing its fiscal policy, will start stimulating. And I think that stimulus will go well into 2022 as well. So that's actually good news for equity markets. So the party, you would argue, is on exactly when economy is weakening. Or to put it another way, as an investor, if policymakers are content and happy, you should be very worried. If, on the other hand, they're becoming concerned, you should relax.
Okay, well, let's talk about a sector-by-sector basis then, because we've been witnessing just in, of course, the last week or so, a number of those big tech names, some of the education names when it comes to China really hit on this increased regulation. But Emily was then just running us through these stellar numbers that we got out from HSBC. How do you position then, if we are going to see a loosening in policy in China, how do you take advantage of that? What particular sectors do you like right now?
Well, HSBC is not China, and it's not MSCI China, so it's not particularly relevant. But clearly the way forward would be that whatever government wants to do and whatever objectives the government has, investors have to be in line with those objectives. Pretty much all assets, whether they're nominally private or public, are now national assets within the purview of the state. And therefore, both shareholders and investors are sort of temporary stewards of national assets. So the first thing to remember, one needs to be in line with what government objectives are. Secondly, I think what you're going to see as China stimulate, more money will go into more cyclical sectors in China, at least for the next 6 or 9 months. And the third point is, to some extent, performance of the index will depend on how long the regulatory attacks against new economy last, how far do they go, and also on geopolitical pressures. If you were to argue the way we do, that this regulatory wave has already crested, there will be another one coming through in the next year and 2 and 3, but this particular one has crested. And if you were also to argue that China has many anniversaries, Olympic Games coming up, and therefore geopolitical pressures, at least in China's sense, ought to come down a bit, then the combination of weaker or looser monetary policy, combination of greater stimulus, lower renminbi, because probably China will be stimulating exactly when Federal Reserve will start tightening, greater cyclicality within China, perhaps a little bit less of an impact of regulation and geopolitics. I think it augurs well for Chinese equities for at least the next 6 or 9 months.